Record na. Ano to? Okay. So we are now in non-controlling interest of 92,160. 92,160. Now you have a follow-up solution to that. 92,160. We have the common stock of 240,000. Yan is. And then we add the retained earnings of S. Initially, 120,000. And then we add net income, 60,000. The total, 180,000. We deduct the dividends paid by S of 36,000. So 144,000 added to 240,000. We get 384,000, and then we add 90,000 as our undervaluation of assets, and deduct 13,200 for the amortization and depreciation. So 384,000 add 90,000, deduct 13,200. The difference is 460,000, and you multiply that by 20%. You get 92,160. So the total stockholders' equity, adding X and Y, is 1,182,600. Your liabilities and stockholders' equity should equal the total assets. So that's 1,779,000. 1,779,000. I hope you will add the liabilities and the stockholders' equity. So you simply add liabilities, total, letter K, and add letter C1. So you add letter K and add letter Z1. So 596,400, add 1,182,600. That will give you your liabilities and stockholders' equity that should tally with the total assets. Okay? So we just fill up the first column in the worksheet. The first column in the worksheet. However, if we try to fill up the next two columns, most of the figures are the same, except for a difference of 2,250 because of the difference between the full goodwill and the partial goodwill. So I will no longer involve discussions of some of these items as we have already discussed them. Some were already discussed yesterday. Some I am discussing today. So here we have the amounts as stated for the alternative solution. So we have the amounts of the 80% or the partial proportionate goodwill. So take note that we have the undervaluation in the amount of 90,000. And then for the net book value, again, equipment undervaluation of 96,000. And the overvaluation. Here, as I have already told you, we have the consolidated net income, and we have the non-controlling interest net income, And finally, the consolidated net income for 20x4. Okay? On subsequent to date of acquisition, the consolidated retained earnings should be computed as follows. So we have now the consolidated retained earnings on December 31, 20x4. We have already extended that in our worksheet, amounting to 490,440. Then we now, the goodwill recognized on consolidation purely relates to the parent share. NCI is measured as a proportion of identifiable assets and goodwill attributable to NCI share is not recognized. The NCI on December 31 X4 are computed as follows. So this is the one that I told you with an amount of 92,160, which we already extended in letter Y of the worksheet. So for our shareholders' equity, again, we have extended the amount in letter X. X1 of our shareholders' equity. So as I have told you, the figures stated are supported by so many computations in our paper. So my objective is to complete problem 1 today. So by tomorrow, we are going to continue with the next problem. Okay? Here, we have the
Ano po?
non-controlling interest. Yes? Any questions? Oh. So we have now the non-controlling interest, net income for 20x5, the net income of the subsidiary, 90,000. Then we are going to deduct the amortization, the goodwill impairment. Now we will have a table for this in the amount of 80,400, and the total we are going to multiply by here. We multiply by 20%. So we get 16,560. Then we add it to the controlling interest of 258,240. We get the consolidated net income. Now let me work backward for the table. Dali lang ha. Let me work backward for the table. As stated, there is a table. Okay. Let's continue going downward. Here. Consolidated net income from separate operations. So we now refer to the next year. P company, given we have the consolidated net income, no, for P company and S company. By the way, we can find this in the next solutions. Then we have the controlling interest in net income of 16,560. Then we have to reflect your 7,200. The amortization table and the one that we showed in solution 1B, 7,200. So we now get the amount of the total net income allocated to the non-controlling interest of 23,760. Now, anyway, allow me to just continue with this. The objective is we will go back to the worksheet under the full goodwill, no? balik ta anay sa aton nga worksheet under the full goodwill. Before we move on, I'm moving backward. Before we move on to 20x5. Mabalik ta anay to sa requirement number 2 nga may full goodwill. Okay? Ara ho, ang aton nga second column nga may full goodwill. Okay, go back. Second column please. Here na. So ang aton nga full goodwill, we still have the same amounts for cash, accounts receivable, inventory, land, equipment, and buildings. And we have the total assets earlier. Again, we have to change this. Kaya nga aton diri nga goodwill, we have to add goodwill in the amount of 12,000. Sangkaina, 9,000. Okay? Kay ang aton nga treatment, partial goodwill, 12,000 minus 3,000. So here we have goodwill amounting to 12,000. We have to add goodwill. So will you compute, however, the goodwill in the computation of full goodwill is subject to impairment loss. So how much is the amount of goodwill that we have to consider here? If we are now using the full goodwill basis, the total amount of goodwill is 15,000 full goodwill. Then we have the partial goodwill amounting to 12,000. So you get the difference of 3,000. And then we deduct the impairment loss attributable to the non-controlling interest. So we have the difference between the partial goodwill approach and the full goodwill approach in the amount of 2,250. 2,250. That is if we adopt the full goodwill approach. If we adopt the full goodwill approach. So, how much now is the balance of your goodwill account? How much is the balance of your goodwill account? In column 1, when we involve the partial goodwill, the balance of the goodwill account was equal to 9,000. How about this time? If we have the goodwill, positive goodwill at full amount for 15,000 debit, then we credit to goodwill for the impairment loss amounting to 3,750. 3,750. So the debit to goodwill is 11,250. That's net of impairment loss if we adopt the full goodwill approach. Again, after investment in stocks, you may insert goodwill. Goodwill using the full goodwill approach, your debit to goodwill is 15,000, and then you have the credit of 3,750, considering that you are using the full goodwill approach. So your debit to goodwill is 11,250. 11,250. Now, what is your total assets? How much is your total assets? In the first column, we have 1,000,000 779,000. Then we are adding 2,250. I hope you have the amounts correct. So how much your total assets? Huh? Did you get the total of your total assets? You exactly have the same amounts above. Only that goodwill, you have it at 11,250. So, how much is the total assets under the full goodwill approach? Pila class?
1781 to 50.
1781 to
To
50.
50.
1,781,250. Right. Okay? Then, everybody, did you get the amount?
Yes,
Everybody?
ma'am.
Yes, ma'am.
Okay. Then we go to accounts payable, the same. Bonds payable, that is for the same amount that we have in column 1. So your bonds payable is minus the discount. So your total liabilities is 596,400. Common stock, the same. How about your retained earnings? How about your retained earnings? It's still the same, 490, 440. How about your 490, 440? And then we have your controlling interest in net income. We have the non-controlling interest in net income. So you
90.
have the amount of 8,610. Why? Because we have 9,360. We are going to deduct 750. 750 is the amount of the impairment loss that will go to the non-controlling interest. Since we have recognized the total of 3,750, so 750 will go to the non-controlling interest. So how much is the net income? That's the amount reduced by 750. And as we move down, common stock, 600,000. We now have your retained earnings accumulated and the controlling interest, equity, okay. And we have now the non-controlling interest equity of 94,410. 94,410. It differs with an amount of 92,160. So 2,250. Okay? So the non-controlling interest is increased to 94,410. So we have the total of the stockholders' equity equal to 1,184,850. Your total liabilities and stockholders' equity should be the same. We have your total liabilities equal to how much? And this time, we have the non-controlling interest. We have recognized a different amount of non-controlling interest in net income. That's for an amount of here 8,610. Okay. So how much is your total liabilities and stockholders' equity. Total liabilities and stockholders' equity should tally with the total of your assets. Okay na? Okay? Let's move on to the next columns. I hope you'll be reviewing what we are discussing now. It's a very, very long process. Yes? Okay na? Oh, let's continue with, we focus on the requirements. These are all supporting computations. Now you are familiar with the amounts because we already have this in our worksheet. However, our concern now is to move on and work on the rest of the requirements before our time ends. We are ending at 11:40. I think I will have another renewal so we can finish all. Okay? Now we go to the journal entries. Let's refer to requirement number 3. Requirement number 3. Prepare journal entry to record the investment in the books of the acquirer. Requirement number 4, prepare a schedule for determination of and allocated excess. 5, the working paper elimination entries. And 6, the consolidated working paper. So we are now given these figures. You try to review on this. Let's move on to our journal entries. Actually, we have only one journal entry for each year if we combine and call it adjustment and elimination entries. Adjustment and elimination entries. Okay? For our next set of requirements. Okay? So we have now your requirement number 3 in the books of S company. Okay. Now with requirement number 3, what are the journal entries to record the investment in the books of the acquirer company? So we have now the acquisition of S company. The entry of B company is to debit investment at cost of 372,000 and credit to cash. So debit investment and credit to cash. Now for the acquisition. And for the dividends received from S company, the dividends issued or paid by S company was 36,000. 80% of that goes to P. So you now debit to cash and credit to dividend income since we are using the cost method of accounting. Otherwise, if we use the equity method of accounting, then there can be a different entry. So debit to cash, credit, dividend income, or you may debit to dividends receivable. For in the books of S company now will debit to dividends and credit to cash. Now, for the schedule of determination as a requirement in number 4, for January 1, 20x4, you have these figures. The book value of the consideration, fair value of the subsidiary is 372,000. That is because we have a non-controlling interest, we have interest previously owned. How do we determine fair value of the subsidiary for that purpose? So we have now the fair value of the subsidiary. The consideration is 372,000. Then we deduct the book value of the stockholders' equity of 240,000. That's the book value of the interest of S as 240,000 is added to retained earnings of 120,000. So actually for the common stock, 240,000 times 80%. For the retained earnings, it's again 120,000 times 80%. So you get 96,000. So we have now the book value of the shareholders' equity of S in the amount of 288,000. And then we have the allocated excess equal to 84,000 for the allocated excess. From the allocated excess of 84,000, we are going to deduct the over-under valuation of assets and liabilities. The over-under valuation. So we now have for inventory. We multiply inventory by 6,000 times 80%. So you get 4,800. Increase in land, 5,760. The equipment under valuation, 96,000. 80% is 76,800. And then your under overvaluation of the building for 19,200. The bonds payable, we have the undervaluation for 4,800. So we now get 3,840. The allocated excess of 84,000, we now have the amount of the under overvaluation share of the parent. So the positive excess, that's the partial goodwill. Actually, that's the amount of the goodwill that we considered in column 1, wherein you only involve partial goodwill. So we now have the analysis. I know you are already familiar with these amounts as we already have them in requirement 1B. So just try to review on these figures. So for the analysis of the amortization, depreciation, we also have this. The goodwill impairment loss of 3,125 based on 100% fair value. That's now in the second year. Would be allocated to the controlling interest and the non-controlling interest based on the percentage of total goodwill each equity interest received. For purposes of allocating the goodwill impairment loss, the full goodwill approach is used. So the consideration transferred initially of 372,000, then the fair value given by the NCI is 93,000. The total fair value of the subsidiary is 465,000. By the way, with regards to, in relation to our examination, we have to distinguish between total consideration transferred and fair value of the subsidiary. If there is no NCI, and no previously held interest in the acquiree, your total consideration is equal to the fair value of the subsidiary. However, if you have the other two, including the NCI and your previously held interest in the acquiree, your fair value of the subsidiary is the sum of the three. So it's not only the total consideration, but you're adding the other two items. Okay, so going back to these computations, we have now the difference of 105,000, and we are going to add or deduct the under overvaluation in the amount of 90,000. That gives us your goodwill equal to 15,000 if we use the full goodwill approach for number 4. And we go to requirement number 5, the consolidation working paper that will involve the elimination entries under the partial goodwill approach. So we now debit to common stock of S to eliminate common stock. Also debit retained earnings of S, and now we credit to investment in S company. Actually, the investment made was 372,000. However, we have your amounts for the non-controlling interest. If we go back there, the investment, the consideration made by the parent was 300